Let's get your week started. Live from New York City this morning. Good morning, good morning. Your equity market just about positive by 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, looking forward to a central bank triple header. As data in Europe starts the quarter on a weak note, China's leadership pledging to support consumption. We begin with the big issue, a central banking trilogy.
It's certainly a big week.
They're going to hear from the three central banks.
The Fed and the ECB.
The BOJ.
The Fed remains king.
They will deliver a July hike.
That's in the cards.
25 basis points at the ECB and at the Fed for next week is priced in.
Pretty well priced in.
The ECB is still catching up on the policy front.
The central bank and the council is very anxious about inflation.
They're probably going to hike, a little bit more than the Fed.
ECB, Bank of General, start to sort of blink. BOJ stance on yield curve control.
They might widen the yield curve control.
The question is, what kind of signal do they give us?
We need clarity from the central banks.
We're going to get a lot of clarity this week.
Let's hope so. Joining us now to discuss, John Hancock's Matt Miskin, Lisa Hornby of Schroders. To the two of you, thanks for being with us. Lisa, first to you. What to expect from Chairman Powell on Wednesday? A hike, and then what?
Yeah, I think really the only question is what happens after Wednesday. I mean, the 25 basis points hike, I think, is a done deal. I think the market will be looking to whether or not this hiking cycle is over. I don't see a need for Powell to be overly dovish. There's not a lot to be gained here to kind of front running the idea that inflation is behind us. I think the market will try and test him on that. But I do think the key will be whether or not the improvement in inflation is enough at this point, or whether they want to see some labor market softening in addition to what we've seen on the inflation front. My suspicion, this is probably their last hike. I think that, monetary policy works with a lag. I think policymakers know that. We're seeing, some evidence in some parts of the data of slowing. But I don't think that they want to directly say quite yet that this is the end of it. I think they want to leave the door open and stress that data dependency here.
Matt Miskin, he's been burnt once, embracing disinflationary trends. Do you think he'll risk being burnt twice?
No, and I think he almost has to be like a parent in that he almost has this threat out there of, hey, if things get too out of whack here, I'm going to have to keep raising rates. And Powell's really going to have to do a lot of the heavy lifting. We don't have the summary of economic projections kind of still reaffirming those higher rates by the end of the year. So Powell's going to have to take the mic in the press conference and really guide to a firmer outlook, meaning rates staying where they're at. But for us, really, this is likely one and done. And that, like the other guest here said, that we're going to need to see this lagged impact of monetary policy that we think is going to hit in the back half. And that's going to really cause growth to decelerate in our view. We're waking up to weaker global growth this morning. We think that's going to be the trend of the second half of 2023.
That seems to be the suspicion that a lot of people share. We caught up with Ian Shepperton of Pantheon Macroeconomics a little bit earlier this morning, Matt, and he was saying slower growth, downshift in payrolls, better inflation prints, make a September hike very unlikely. Do you think that weakness you anticipate will become apparent by the time we get to September, and why?
Yes, we do. And really what you're seeing is the jobs market. Basically, the whole outlook of the Fed is being held on by one data point, and that's initial jobless claims. I spent all weekend just looking at this. Initial jobless claims coming back down to 220,000. It's almost like that is, the meme where it's showing that's holding on the whole financial system like Excel is or something else. It's basically all coming down to that. And if the labor market starts to crack, which it's already showing this deceleration, you're starting to hear about this in some layoff announcements, but if initial jobless claims rise by September, which in our view, they are likely to do so, that's going to mean the Fed's got to look at the other side of their dual mandate. They've got to look at employment eventually. And we think that's going to be the second half story. That's going to cause them to pause and even start to potentially talk about easing as we get into 2024.
So, Lisa, two issues then. You could get this slowdown in jobs growth. Maybe you get this weakness in the labour market, though we should know that people have been talking about that for the last 12 months and it still hasn't happened in a material way. And, Lisa, what it might come down to is tolerating higher inflation. PIMCO is saying they'll tolerate 2 point something, maybe 2.8, maybe 2.9. Do you see them tolerating that at the Fed?
Absolutely. I think they almost have to. I mean, almost by definition of managing this debt burden in this economy, you almost have to have some sort of surreptitious deflation of the debt. And the way you do that is having sort of higher nominal inflation over the longer term, and keeping policy rates lower than that inflation rate would suggest. So I absolutely think that's the play. I don't think they want to say that quite yet. I think it'd be very, very premature for them to acknowledge that. But I think in reality, that's probably the world we're heading for, one where they tolerate slightly higher inflation.
Elisa, if that is the world we're heading for, how do you think this yield curve evolves with that in mind?
You know, in our view, the curve will end up steeper over the next, let's say, 12 months. It's just a matter of when that steepening really starts to emerge. We've been hesitant to start putting the steepening trade on just because of the cost and the timing. You know, getting the timing right is really important. This curve is very inverted, and I think the market doesn't want to start re-steepening the curve until there's conviction that there are some cuts coming. And, you know, the Fed is definitely pushing on this mantra of higher for longer, which has challenged the idea that there's cuts in the next sort of 6 months. Those cuts have been pushed out, and they're much fewer. In sort of middle end of 2024. So I think we have to wait a bit longer to see the curve materially re-steepen. We may get some fits and starts, but I think ultimately the curve belongs in a much steeper place than it is today.
Matt, can it get any more inverted than it is today, with a 2-year at 4.83 and a 10-year at 3.80?
It's unlikely, and I think Lisa's right. I mean, I think eventually we get a bull steepener out of this. That's what typically has always happened after inversions to this magnitude. There's only one way out, historically speaking, and that's the 2-year dropping faster than the 10-year, and the 10-year dropping in sympathy with that. I do want to just hit on one other thing, John. You were talking about the Eurozone as a microcosm earlier on surveillance, and that to me is actually a huge point, right? So what we're seeing right now in Europe is they're raising rates into a recession to take down inflation. When you talk to Lisa about will inflation come down, I think Europe is a great example for the Fed to look at and say, look, they might have to keep tight policy even as the economy hits a recession. To me, that likes bonds even more. It's just a matter of timing. Yeah. But that is a development that I think is really key that the Fed's watching.
If we had that dynamic stateside that Europe has right now, risk assets, I imagine, would look very different. Hiking into weakness, you've still got an inflation problem, and the PMIs look absolutely brutal this morning. Europe needs a favour, and it needs that favour right now from China. We had top leaders meeting. It starts this week. It started today with the Politburo, the leading body of policymakers led by Xi Jinping. On the latest down in Washington, I can get across to Enda Curran for more. Bloomberg's very own. Enda, what have we learned from China this morning?
Probably not much of a spillover for the global economy from this, John. This is the Politburo meeting. They focused on boosting consumption, helping out the real estate sector, and a lot of talk about alleviating debt on local governments as well. So within that, there might be some debt restructuring and debt swaps. Our colleagues have reported some measures to boost consumption, make it easier to buy cars and furniture, for example. And then the real estate side of things, measures expected there to try and speed up the purchases of property given the 2-year real estate slump. Now, no change to the fiscal policy outlook, no change to monetary policy. Markets were disappointed by it. A lot of economists saying fairly modest steps by the government seem to be focusing on sustainability over big bang bazooka. So I think anyone looking at China from the outside in this morning, hoping for a big lift for the second half of the year, probably won't be getting it from this announcement.
Pretty incremental stuff. Enda Curran down in Washington. Enda, thank you. Matt Miskin, you took us to the subject. Europe right now needs a favour from China, doesn't it? Is it getting one?
That seemed like rerun headlines. Is this what we're doing now, where we're just like recycling headlines of past meetings, or in the Eurozone that has happened, or in the oil markets? But really, that's not incremental. And to your point, John, I think that's really what's actually helped the euro and European equities is this constant China headline development of more stimulus, and that's what it's been trading on. But I think that you look at the data, and the Eurozone Economic Surprise Index was already at over -100 before the data this morning. So it just seems completely mispriced in our view. It's a late cycle indicator. Last time the ECB was raising rates into weaker growth was 08 and 11. It didn't end well. You look back at context, though, in this cycle, this isn't a great setup, in our view, for European risk assets.
That's a big call, that is, to bring up 08 and 11. I don't know if you're implying that we face a similar risk this Thursday, Matt. Are you?
Sovereign debt crisis hasn't been, we can't rule that out yet. Everything's been trading so well. I think the biggest risk is that there's very little risk being priced in. And I think it is due for a bit of volatility after such everything's been trading on the bright side of every development. And I think you have to acknowledge the risks given the slowdown in the economy.
Elisa, what's your take?
Yeah, I think Matt's comments are fair. I don't know that I'd say it's quite a repeat of 08 or 11, but certainly we're seeing the data weaken we've seen the data weaken quite materially in Europe, manufacturing data, tighter financing conditions. I don't think it's a great setup, and yet, they're also in a place where the labor market remains resilient and inflation remains too high. So, I think some of the policymakers there certainly think there's further to go. In a lot of ways, it's similar. There's a similar situation in the U.S., but I think the underlying growth rate here, certainly the potential growth rate here is higher. So it gives us a little bit more wiggle room than I think they face in Europe at the moment.
Lisa, help me with this. Let's pick out the 10-year. Just a maturity, for example, in Europe right now. If we face more economic growth weakness, but we face more inflation pressures and inflation sticks around and it's sticky and it's a problem for the ECB and they have to keep hiking, should I buy the 10-year in Germany, in Italy, or should I sell it? What do I do with that?
I think that the answer is probably different depending on the region. I think, Germany, you could maybe make an argument where a 10-year long term is an okay buy. I think Italy becomes a bit more questionable because we bring debt sustainability into focus as we look out further in the future. At the moment, we're sort of cautious on Europe overall. We prefer to take our duration in the U.S., especially when we've seen yields up near 4% in recent days. I think that's much more attractive risk reward for us.
5 days of euro weakness, longest streak since May. Euro dollar right now about 110.90. Matt, just one final one for you on this inflation dynamic in Europe. We caught up with George Bory about this in the last couple of weeks, and I think it's an important question. Do you sense that, regionally speaking, inflation trends are going to diverge or converge, Europe versus the US?
Converge. And, the same thing for yields. When Lisa was talking about, US yields were following European yields, UK yields higher. And now as they start to roll over, that's going to be an anchor for US yields. So, a lot of people are like, well, there's all this divergence. At the end of the day, we're in a global inflation cycle, and we likely are only going through the part where disinflation is being materialized through the supply chains being normalized and some of the commodity shock coming off. We probably haven't even felt the tighter monetary policy part, which is what we're going to feel in the back half of this year into 2024. That's on a global basis. It's a disinflationary phenomenon that is likely to be global in the back half.
Matt Miskin, it's Monday. I can't get my words out either. Matt's going to stick with us alongside Lisa Hornby, about 18 minutes away from the opening bell. Equity futures positive by 0.2%. Let's get to Abby for some movers. Morning, Abby.
Morning, John. And one reason the futures are higher, Apple, the largest member weighting to the S&P 500, up modestly, but poised for its first up day in 3. This as the company has held its iPhone view for the year. They're targeting 85 million units, roughly in line with last year. Tesla, on the other hand, not so much, down 1.4%, heading to a 4th down day after profitability concerns did emerge last week in their recent earnings report. Plus, this could possibly be some sort of weighing in on X, or the old Twitter. And then finally, take a look at AMC, soaring up 33.4%. This as a stock conversion plan was halted by a judge, but some experts are saying it will go through in a modified form. If that happened, John, a huge overhang is gone for that stock.
Abby, thank you. Coming up on this program, investors gearing up for a huge week of earnings.
Tech earnings are going to be, very important as far as holding up this market. Our baseline view, though, we upgraded tech in March. We think we're in a resting period. We still think tech is leadership.
Results from Microsoft, Meta, Alphabet, Amazon, all on the agenda this week. That conversation up next.
tech earnings are going to be, very important as far as holding up this market. Our baseline view, though, we upgraded tech in March. We think we're in a resting period. We still think tech is leadership. The economy does slow down later in the year, as we expect. I think companies are going to have to continue to invest in technology regardless, and that should support better earnings from tech relative to the broader market.
Earnings season ramping up this week. About 40% of the S&P 500 reporting results, with big tech very much in focus. Aberdeen's James Athey warning, quote, if guidance shows any sign of concern, that could be enough for investors to flee those stocks. Katie Greifeld has more. Morning, Katie.
Morning, John. Well, there's a lot of different superlatives here. If you take a look globally, you have 27 trillion of market cap reporting. If you focus just on the U.S., nearly 14 trillion, with 165 companies in the S&P 500 due to report. And of course, a lot of focus is on the likes of Microsoft, Alphabet, and Meta. Of course, after what we heard last week from Tesla and Netflix, but it's not just big tech. You also have companies such as McDonald's, Coca-Cola taking the stage this week, as well as Exxon and GM. So we get a multi-sector look at the economy this week through the lens of corporate earnings. Of course, this comes with very high valuations on the benchmark. We're talking at the S&P 500 trading at almost 20 times its forward earnings. That's a premium to its long-term valuation. On one hand, you have Morgan Stanley saying that raises the bar for this quarter. Then you have Goldman Sachs on the other hand saying that actually that valuation could rise further as this rally broadens out. So we'll find out.
Katie, thank you. Matt Miskin, Lisa Hornby back with us for a final word on some of this. Matt Miskin, the dominance, the narrowness of this market and big tech outperforming in massive ways. Do you expect it to be validated by the earnings this week?
Yeah, I don't think it's going to be bad, frankly. I think it's going to come in pretty much in line, a little bit better. I mean, earnings thus far have been pretty strong. We're up about 7% on reported earnings. But the analyst community is saying, don't get too excited, because they've actually revised down their 2023 earnings estimates to about 0. And even in the Q2 numbers, they're looking for negative 9% for the rest of the 80% of companies reported. I thought it was interesting, Katie, talking about the valuations. Now we're looking at nearly 20 times earnings. One of the things, I mean, in this industry, to get a designation, you have to do discounted cash flows until your eyes bleed. And right now, it's just amazing how detached academic valuation analysis is relative to the markets. The fact that the discount rate, or basically the risk-free rate, has doubled in the last year, and yet the multiple hasn't changed much, or the net present value of these cash flows, is pretty amazing. So you got to leave your textbooks at home, I guess, when you value these companies. But in our view, they're pretty richly valued. Earnings estimates aren't that great, and to us, bonds and income are going to be much better return potential from here.
Matt, we've talked about the underperformance of the NASDAQ more recently, just within equities, not cross asset, within equities. What would you rotate to, away from big tech, to what?
I just think it's interesting even within the NASDAQ. So, you've got communication services, consumer discretionary. We're actually underweight those parts of the market. We are overweight the quality part of tech, which is more just the traditional tech sector. We are barbelling that with healthcare and some utilities, defensive equities. Defensive equities have gotten slammed in the first half. They've massively underperformed. We think that sets up a nice reversion and potential rotation opportunity in the back half if growth slows. So holding on to some of that quality, that good tech, the high quality tech, and then starting to migrate more into the defensives in the back half of this year.
Elisa, within stocks, all I hear is rotate. This is going to broaden out, go away from tech, get to cyclicals, energy, finance. Lisa, all I hear in credit is get up in quality and avoid a lot of that. Is that right?
It's funny, as you were talking about the equity market and how it's basically bulletproof, I was thinking, I'm just glad I'm a bond person, because you can earn really attractive income now just sitting in very high quality bonds. And I think that's the name of the game here. It's, within credit, it's up in quality. I think banks still offer some value here. One of the cheaper sectors, utilities have gotten beaten up a little bit on the back of some idiosyncratic issues, on the back of CapEx spending, but I think there's some opportunity in some of those as well. I think some of the defenses outside of credit, I think, agency mortgages, government guaranteed housing product, effectively very, very cheap valuations historically. I think that looks like an attractive asset class to own. And, lastly, I mentioned it before, government bonds here, treasuries, close to 4% on the 10-year. I think we're going to look back on that and say it was an attractive entry point.
Elisa, don't you find it weird that we're talking about 4% being attractive on a 10-year in America? A growth slowed down and high yield spreads are at 376 on my screen at the moment.
I go back to quality, defensive, liquid. Going to be happy we own some of that type of stuff, I think, in the next 6 to 12 months.
Lisa Hornby, thank you. Alongside Matt Miskin. On the equity market, credit market alike, and the central bank decisions coming this week. Thank you very much. The Federal Reserve on Wednesday, ECB Thursday, BOJ on Friday. I've talked a lot about the earnings this week and the earnings calendar. Just an updated correction on Amazon. It was coming this Thursday. It's now coming next Thursday alongside Apple as well. Your equity market at the moment on the S&P 500 positive by 0.2%. On the S&P, a lift in the equity market. In the bond market currently, yields basically unchanged on a 2-year. Your 2-year 4.84. Your 10-year yields a little bit lower there by a couple of basis points at about 3.82. We had a break of 3.80 to the downside a little bit earlier off the back of that weaker than expected data out of Europe and out of the UK. It's the US's turn in about 25 minutes' time. Mike McKee's going to break down the economic data for you. Up next, the morning calls, and later, Dan Suzuki of RB Advisors sounding the alarm on tech leadership. That conversation at the opening bell, about 8 minutes away. About 5 minutes away from the opening bell this morning. Good morning. Let's start with equities. A little bit of a lift here on the S&P 500, up by 0.2%, nudging a little bit higher, in line with the Nasdaq. Not the story of last week. Underperformance on the Nasdaq 100, a bit of outperformance on the S&P, the equal weight, and all that other good stuff. Away from the dominance of big tech, it will be all about big tech through this week, with earnings from Microsoft on the likes of Meta and Google and all of that. And then on to next Thursday, Apple and Amazon. Right now, then, equities with a lift in the bond market, a bit of a rally from earlier on. A 2-year that's about unchanged, a 10-year yield that's lower by a couple of basis points. The 10-year at the moment about 381.53. Weakness in the PMIs, manufacturing and services out of Europe. Likewise over in the UK. Let's see if we get a repeat of that act at about 20 minutes from now when we get US PMIs. Look out for that. Let's finish on foreign exchange. Just push that Eurozone weakness through the FX market and you get a 5th day of Euro weakness against the dollar. Euro dollar right now 110.80. We're negative there by 0.4% on that currency pair. That's the price action. Let's get you some morning calls. First up, Piper Sandler downgrading Estee Lauder to neutral, highlighting the stock's unappealing valuation and rising competition. That stock is negative by about 2% at 176. In the pre-market. Your second call from UBS, downgrading Tesla to neutral, seeing limited upside following the stock's massive rally this year. We're down 1.3% there to about 256 in early trading. And finally, Baird upgrading Netflix to outperform, growing increasingly confident in the company's execution and new advertising strategy. We're a bit softer there, weaker, after a pretty dreadful week on that stock last week. We're negative 0.4%. Coming up, Dan Suzuki of RB Advisors saying big tech's narrow leadership is unsustainable. That conversation up next. Your opening bell just around the corner. We are 23 seconds away from the opening bell this morning. Good morning to you all as we kick off the trading week this Monday. Equities just about positive by 0.2% on the S&P. On the Nasdaq 100 up by, let's call it 0.25%. A monster week coming up for big tech and that index specifically, with gains of more than 40% year to date. There's the opening bell. Switch at the board and get to the bond market. A rally this morning in treasuries. We give some of it up. We're down about 2 basis points on a 10-year, just north of 380 after spending a little bit of time south of 380 earlier on in the session. 381.53 off the back of weak economic data in Europe and in the United Kingdom. Data out of the United States about 15 minutes away. The single currency, the euro, 5-day losing streak. Weaker euro, weaker euro, weaker euro, weaker euro, weaker euro. I think that's 5 times. Euro dollar 110.80 on that currency pair, negative 0.4%. And crude higher by about 50 cents, $77.56. We're positive by 0.6% this morning. That's the cross-asset price action. Here's a single name, AMC. The company today revising its stock conversion proposal after a judge rejected an earlier version last week. The CEO writing in a letter, AMC must be in a position to raise equity capital. The risk of financial collapse is not whimsical. Abby has more. Morning, Abby.
Morning, John. And this stock is soaring on this news, up more than 30%, its best day since March of 2022. And it's a pretty complicated scenario. It goes back to earlier this year when the company did vote on a proposal to raise capital, as you're talking about, the CEO saying that if they don't raise capital, they could be out of money by later 2023 or 2024, and also issue new shares. Now, shareholders at that time sued the company because of the dilution. Then they agreed on a settlement where those shareholders would receive about 129 million in shares, and everybody was happy with that. But a surprise, on Friday, the judge rejected that plan, saying that she wanted the settlement to be a bit more narrow. She basically said that the preferred shareholders would have been included in that settlement, even though they weren't a part of that litigation. So now this new settlement that both the company and the investors have proposed, it releases those preferred shareholders in case they do want to litigate in the future. But it also may bring the settlement down to about $100 million. The biggest thing, though, John, it looks like they are going to be able to raise that capital, to your point and the point of the CEO. Plus, a major overhang on the stock, well, it's potentially going to be removed.
The stock is up by 20%. Abby, thank you for that. We're about 2 minutes into the session, positive by 0.4% on the S&P. On the Nasdaq 100, positive as well on the Nasdaq. The broader composite, we're up by about 0.5%. Let's stick with theatre. Monster weekend at the box office. New releases Barbie, Oppenheimer, bringing audiences back to the big screen, helping cinemas turn in the best weekend since 2019, providing a big boost for shares of Mattel and Warner Brothers. Katie Greifeld has more. Morning, Katie.
Morning, Jai. Yeah, both shares of Mattel and Warner Brothers Discovery higher today after, like you said, it was a big weekend at the box office. All told, box office revenue came in above $300 million, just a hair above. That's a 4-year high, like you mentioned. It's more than double this weekend a year ago. And if you break down that $300 million, of course, it was Barbie that pulled in about $155 million in ticket sales. That makes it the highest grossing debut of this year. And then you have Christopher Nolan's Oppenheimer. It brought in almost $81 million. And John, I don't know about you, but an estimated 200 plus people bought tickets for the same day to see both shows, Barbenheimer or Oppenbarbie, if you will. But in any case, this is a big boost for the theaters after what's been, or during, a difficult summer. We've had some expensive flops in the form of The Flash and Indiana Jones. And of course, as those twin writer and actor strikes drag on in Hollywood. So a little bit of good news.
They're insane. I couldn't spend that long in a movie theatre. Katie, thank you. I struggle to get through 2 3-hour movies. The idea of going to 2 back-to-back is just too much. What do I know? 3 or 4 minutes into the session, let's shift to earnings and big oil. Chevron posting better than expected results and extended its tenure with CEO Mike Wirth. Analysts at Citi saying this: there's little doubt that a quickening pace of growth in the Permian has been a key factor to these results. Simone Foxman has more. Morning, Simone.
Morning, John. Yeah, there was record oil equivalent production at the Permian Basin in the second quarter, 772,000 barrels. But broadly, the earnings report preliminary announcement coming on Sunday was better than analysts expected. EPS for the quarter coming in at $3.08 a share. That's above $2.91 that analysts were looking for. And profit more broadly, $6 billion rather than the $5.5 billion that the street estimated. But the biggest news may have actually come on the management front. CFO Pierre Breber will retire in 2024. He's been CFO since 2019. He will be replaced by the current CTO, Emmer Bonner, who will take over on March 1st. Also waiving the retirement age for the CEO, Mike Wirth. He's 63. The current mandatory retirement age is 65, so it looks like he'll be around for a little bit longer. JP Morgan talking about how this represents an orderly transition. RBC saying it's looking for more commentary about an ongoing project that the company has in Kazakhstan. Those full picture comprehensive earnings will come out on Friday, John.
Simone, thank you. That stock is up by 1%. Here's a name that's down 1%. Tesla negative for a 4th consecutive session. Longest losing streak if this holds since April of this year. A downgrade from Baird. The analyst writing, quote, "We think the recent rally fully reflects the strong demand response seen after the price cuts, as well as solid execution in 2024. Going forward, upside risk to earnings, consensus seems very limited. Risk reward looks balanced." The latest there from Baird on Tesla. I want to stick with tech and get to Apple. Said to be asking suppliers to produce 85 million iPhone 15s this year. That's about in line with the year before. Bloomberg's Mandeep Singh joins us now for more. Mandeep, how are they going to grow revenue if they're going to keep shipments basically the same?
Well, so think of what happened last week when TSMC took down its guidance by 10%, and they called out weakness on the smartphone and PC side. So clearly, I think this calms down the nerves in terms of Apple really seeing a big decline with their new launch. But you're right, flat shipment isn't very encouraging, although I would say you will see ASP growth with any new Apple product launch. And we've talked about, how semiconductor content is growing. Guess what? You will have some new features, so you will see ASP growth make up for that unit shipment flatness.
So higher prices potentially on the pros. Dan Ives has talked about an upgrade cycle, Mandeep, for a long, long time. Is that going to encourage that upgrade cycle, knowing that you've got to pay a whole lot more to get an iPhone?
I mean, look at, all this AI wave really unfolding this year. And if large language models is that big of a deal, which everyone thinks it is, you need a better hardware on the edges. And the best piece of device you have on the edge is your smartphone. Yes, you would need to upgrade your PC, but look at the amount of time you spent on your smartphone versus any other device. So you would need to upgrade that smartphone. And I think that could catalyze a big refresh cycle in the next 2 to 3 years.
Mandeep, do you expect that upgrade to come this year, or is that a next year story?
I think right now, Apple is probably early into planning for large language models and what it could do at the edge level. Again, the exposure that Apple has is at the edge. It's not really looking to train its own large language model, but clearly that is the way you're going to consume all the new innovation around chatbots or virtual agents. I mean, I would love to see Siri improve. And that's the kind of thing you're talking about when it comes to new hardware that could catalyze a refresh cycle.
Siri on steroids, yeah. AI. Mandeep, thank you. That stock is up by 1.3%. It's just a monster week for earnings in America. Roughly 40% of the S&P 500 market cap reporting this week alone, led by the big names you know well: Microsoft, Meta, Alphabet, some of the year's best performing stocks. Dan Suzuki of RB Advisors sounding the alarm and writing this: given the extreme market concentration in tech-related companies, we remain steadfast in not chasing after such investments. We view the continued dominance of this narrow leadership as unsustainable. Dan Suzuki joins us now for more. Dan, wonderful to catch up with you, sir. I remember when it was unsustainable back in February, back in January, and it continued. Why is it unsustainable now?
Yeah, well, Jonathan, thanks for having me. And to be fair, I mean, you introed me, a few minutes ago saying I'm ringing the alarm. Clearly, the market and investors have been hitting the snooze button on that alarm. But I do think at this point, we are close to an inflection point. Either you don't have to be a rocket scientist here. Either profits growth is in the process of bottoming and it's going to start to improve, or earnings growth is going to weaken further here, due to, disinflationary risks and the impact on margins. But either way, earnings go, I think tech is going to be a loser, because if earnings reaccelerate here, why would you pay 40 or 50 times earnings when you can get companies with superior earnings growth that are cyclical at a fraction of the cost? Think, energy, financials, small caps, value names, all trade at super cheap valuations, have much more cyclicality, and therefore benefit from a better growth environment. Conversely, if things get worse, you're going to question, paying that type of multiple for companies that don't have earnings growth today, when you can buy companies that actually have earnings growth, the more defensive, less cyclical parts of the economy.
So let's talk about where valuations are better in the cyclical parts of the economy that you mentioned first. What's the argument to buy cyclicality right now when people are talking about the prospect of recession constantly being around the corner?
Well, as you said, Jonathan, people have been talking about a recession for a long time. Clearly, the economy doesn't collapse overnight. And so there's a lot of reasons to believe the economy, any potential recession is still a ways off, with the household and the consumer still as resilient as it is. Now, I think that there's a big debate to be had here, because for every positive green shoot that we've had over the last few months, you've had a very, very important counterpoint, in the leading and important, more cyclical parts of the economy, whether it's ISM hitting new lows, it's increasing distress and delinquencies within the credit markets. It's, a lot of the earnings season, some of the commentary from the companies that have the most exposure to the labor market are saying that the government data is lagging the trends that they're actually seeing in their labor market. So for all these things, there's still some caution out there to be warranted. But if we are in the process of bottoming and we have this conversation 6 months from now and earnings growth is reaccelerating, then clearly, there's probably a lot of upside to earnings for industrials, financials, energy, and tech for that matter. You're just paying a lot for tech when you can get better earnings growth elsewhere for cheaper.
So Dan, tell me, what are you advocating for clients right now? What are you advocating for?
Well, Jonathan, I think the most important thing right now, and you sort of introed it with that quote. Basically, we tell our clients all the time that returns are greatest when capital is scarce. I think what's more tantamount today is the inverse of that, which is that risks are greatest where capital is concentrated and expensive. I don't think there's any debate out there, whether you're a bull or a bear, what part of the market that is. And so I don't think it makes sense to chase that part of the market. I think you're better served elsewhere. And if you look elsewhere, everything else is trading. You'd be hard pressed to find an area of the market that's trading above 13 times, 14 times relative to the S&P 500 at almost 20 times. And so I think you can basically go buy anything out there as long as it's not that concentrated part of the market. If you're worried about growth slowing down, own the higher quality, less cyclical names like healthcare, staples, and utilities. If you think that we're in the process of bottoming and things are going to get a lot better, again, value, small caps, financials, industrials, energy, all that stuff is going to do incredibly well.
Dan, do you think you'll learn more from earnings this week than you will from Chairman Powell on Wednesday?
I think that's right, but I think that's a low bar. I've said for some time on your show, Jonathan, that the Fed is a lagging indicator, managing to lagging indicators, and really what's in the driver's seat right now is growth. Obviously, they're trying to influence growth, but obviously, their impact on that growth, it's not having a huge impact. There are other factors that are bigger as drivers of growth. So, I think the economy has been resilient, so the Fed's had to hike more than people expected. If the economy in the back half slows, I think that more than people expect, I think you'll have an easier Fed than people are pricing in. I think third quarter earnings season is probably a little bit more pivotal in my mind, but I think you're already starting to see some interesting glimpses. I mentioned the commentary around the labor market. I also think you're getting some interesting commentary already about some of the disinflationary impacts and the negative sides of disinflation, whether it's AMC, whether it's Electrolux overseas, whether it's all these different areas of the market. Netflix, one of the areas that market has concerns about is that pricing power is starting to fade. I think the third quarter probably a little bit more information on that front, but you're already seeing some early glimpses.
Dan, it's such a good final point. Thank you, sir. As always, Dan Suzuki of RB Advisors down the equity market. Can't have it both ways. Inflation was good for the equity market. We're saying disinflation is good for the equity market as well. Where does that leave revenue growth? Where does that leave pricing power for some of these companies that Dan identified? Coming up on the program, the latest data out of Europe, not great. In the UK, not pretty. It's the US up next. Economic data in America out just moments ago. Mike McKee has the numbers. Morning, Mike.
Morning, John. It's kind of interesting because the rest of the world looks terrible. The U.S. looks a little bit better by comparison. The S&P Global Manufacturing PMI comes in at 49, up from 46.3. The Services PMI, still a healthy 52.4. That's down from 54.4. And the composite is only a little bit lower at 52.0 from 53.2. Now compare that to what we saw across the Atlantic today. Really, really bad numbers for a lot of countries. Manufacturing for everybody in the 40s, and Germany comes in at 38.8. That's pandemic kind of numbers. Services down in the 40s for France, and the rest of the countries in the low 50s. So a global slowdown. And what's interesting, John, is that we're seeing better than expected numbers in general here, but economists are forecasting a real drop-off in the GDP numbers in the second half of the year, starting with this quarter, the start of this month. They're down to like 0.2% by the end of the year. So we'll see if these numbers hold up or if the economists are right.
Mike, what's the most convincing argument for that weakness they expect to emerge later this year?
They think consumers are basically going to stop spending, that companies are starting to stop spending because interest rates have been high and consumers are starting to run out of money from their pandemic benefits, and they will pull back. We haven't seen signs of it, but stay tuned Friday for the government's spending report.
Student loan repayments and all that stuff. Mike, we've been
debt
arguing this for a while, right?
Debt service levels are really low historically. So at this point, Americans can afford it. It's a question of whether they want to.
Mike, thank you, sir. Latest economic data. The US data not so bad relative to the dreadful data we just had from Germany and Europe earlier on today. Biden, the president, continuing to tout Bidenomics in his re-election campaign tour. Recent polls suggesting Americans maybe aren't convinced. AMH has more in D.C. Morning, Anne-Marie.
Good morning, John. Well, you're talking about the fact that the data shows that the United States is doing better than the rest of the world. That is just not showing up in the polls. And most recently, we had a poll from Monmouth University, which said only 3 out of every 10 Americans feel that the economy is doing better coming out of the pandemic than the rest of the world. So they actually are looking at the rest of the world and thinking the U.S. isn't in such a great place. Even so, what Biden is trying to do, because everyone knows the economy is going to be one of the top issues for the 2024 presidential election, is he's trying to own it alongside the Democrats. They are trying to own the legislative wins, things like hard infrastructure with bridges being built, roads being fixed, capping the price of insulin. The issue is, of course, Jonathan, is that it is just not resonating right now with voters, and that is why Republicans are also happy to see them own Bidenomics, and they're going to try to taint Bidenomics, as that means high inflation and higher costs.
Do they have a plan of their own, Anne-Marie, going into the debates next week, next month?
Well, it depends what Republican candidate you talk to. What are the big concerns? And I think one issue that you're going to see potentially some different views of how to secure it would be Social Security and Medicaid. That'll be one big topic on the debate stage. What you do see, though, all the Republican candidates at this moment do is attack this administration for higher costs and higher inflation. Also, when it comes to tax cuts, something Democrats love to campaign on, that they want to do away with the Trump-era tax cuts, even though they weren't able to do it in the last session when they had control of all of Congress and the executive branch. You're going to see Republicans say that they think those tax cuts should remain in place.
MH, thank you on the latest in Washington and the latest economic data in America as well. The broader market, about 21 minutes into the session, we are positive by 0.3% on the S&P. The Nasdaq just about positive, going into a big week for big tech. Let's get you some sector price action. Here's Abby.
Modest gain there, John, but most sectors for the S&P 500 right now are higher. In fact, 10 of the 11 S&P 500 sectors are higher, led by energy. Both Chevron, as Simone was talking about before, helping, along with ExxonMobil. Real estate up by about 0.8%. Those dividends look a little bit more attractive with yields down. Consumer discretionary down ever so slightly. We're early in the session. It does feel like a lot could change. Now, as for big tech, as we, of course, are coming into the heart of that reporting season for the second quarter, this month right now, big tech is higher overall, up more than 1%. But what is interesting to note, early last week, it had been much higher. So some of those gains are giving up. The big question is, as these reports come in, whether or not that gain can hold. Looking at that chart, John, I'm not so sure, but we'll find out with Meta starting out on Wednesday.
We will. Microsoft coming up just around the corner tomorrow alongside Alphabet. And then more coming next week, of course, with Amazon and Apple just around the corner. Abby, thank you. Your trading diary up next. We said this earlier this morning, it's just one of those really special weeks you get once a quarter when you get all these central bank decisions all at the same time and a ton of tech earnings in between. So on Wednesday, the Fed, on Thursday, the ECB, on Friday, the BOJ, and in between, about 40% of the S&P 500 reporting earnings. Going into all of it as we start the trading week this Monday morning, and good morning to you. About 25 minutes into the session, advancing by 0.1% on the S&P. The Nasdaq actually pulling back. Underperformance last week, underperformance on the session as well. We're down by 0.3% as the small caps, the Russell, advances by about 0.25% right now. That's the equity price action. Let's get you to the trading diary. Coming up this week, we get earnings from Alphabet and Microsoft on Tuesday. Then Meta results coming on on Wednesday, shortly after we get a Federal Reserve decision and Chairman Powell news conference. All of that just around the corner. An ECB rate decision on Thursday, a bit of US GDP as well. Tons of data, ECI, PCE, all of that through the week. And finally, we round out the week with a BOJ rate decision and Exxon earnings coming up on Friday from New York City. Plenty to look forward to this week. Looking forward to doing that with you. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day and the week for that matter. This was the countdown to the open. This is Bloomberg.